Thanks very much. It's great to be back in Sydney. I'm based in Chicago now, so anybody that's been watching the news knows that it's been very cold in Chicago, and so I think the roadshow was well timed, because the day I was flying out of LA, Chicago was minus 30 degrees Celsius and minus 60 with wind chill, and so I'm told it's one of the coldest days in Chicago's history, and I'm very happy to say I wasn't there. So Chris did a great job of providing an overview of the investment principles, and now I'm going to talk a bit about how we apply them in the investment strategies that we have, and I'm going to focus on three main topics. So firstly, I'm going to talk through valuation-driven asset allocation, so what the theory and process is behind that. I'm going to talk about the theory of contrarianism, and then finally talk about how we're currently positioned from a reward for risk perspective across the portfolio. So I'm not going to go into granular detail on each of the investments, but I am going to talk more high level. They bought a table for my water. So most people understand asset allocation. When people hear valuation-driven asset allocation, they're not entirely sure what we're talking about. And so people are very familiar with valuation at the individual security level. But as it relates to asset allocation, they often think more top-down, think more of a macro perspective. Our view is that any asset that pays a cash flow can be valued, and an asset class can be valued in a similar way to a stock or a property or a bond. And so we seek to apply the same principles that bottom-up stock pickers apply to asset classes. And so we think of our approach more as bottom-up asset allocation than top-down. Now, top-down, whenever I go to talk about asset allocation, I often get questions of, what do you think the Fed's going to do next month? What do you think is going to happen to inflation? What's your view on growth in the next 12 months? And I have a very unsatisfying answer to all of those questions. I don't know. And so this is an image that was based off some comments that Warren Buffett made. He said, what you really want to do with investments is figure out what's important and knowable. If it's unimportant or unknowable, you forget about it. And so I would say that there's a lot of stuff that's important and unknowable that people spend a huge amount of time on. So for example, when's the next recession going to hit, the global recession? That's a really important thing to know. And if you knew that precisely, you could position your portfolio to not only potentially preserve capital, but do quite well. You could maybe lever government bonds. But it's not knowable. Most models have predicted 2 of the last 150 recessions. And so it always looks like a recession's going to come. So it's not knowable. And so we really try to avoid spending tons of time on things that we don't think can be known ahead of time. We try to focus on things that are knowable, like cash flows, like the fundamentals. And we try to focus on things over a time horizon where you can say something intelligent about the range of outcomes. Over the shorter term, there's a huge amount of randomness and noise. Over the longer term, fundamentals start to assert their influence on asset prices. So what do I mean by fundamentals? So this is the total return for the US stock market from 1871 to 2016. And it shows you the cumulative return, so it's nominal, and dividends have been reinvested. And so you can see total return about 9.1%. And so what drove those returns? We could say, well, inflation. Generally, stock prices and earnings keep up with inflation, so companies tend to pass on inflation increases over time. Then there's the total payout. So that's dividends plus buybacks, which really started in the US in the early 80s. So you can see the majority of that return, so 4.9%, is really cash flow based. And then each year, companies may pay a little more dividends, or they may buy more stock back, so the cash flow tends to grow over time in line with the reinvested cash flow that isn't distributed each year. And so you see 1.6% growth rate. So in total, fundamentals explain 8.8% of the return. So what you can see is that over the long term, the market prices really reflect the cash flows that are distributed in nominal terms. That's what we mean by fundamentals. Look at the cash flows. Now, as you can see, there are periods where there's a gap between the return, the cumulative return, and underlying cash flows. And they're the parts or the points in history that we think are worth looking at. So why is it that prices don't always follow fundamentals? So Robert Shiller, who won the Nobel Prize in 2013, a famous behavioral economist, effectively developed something which I think is pretty ingenious. This was back in the day in the early 80s where thinking that markets weren't efficient was effectively blasphemy, certainly for academics. And so he developed something which he called a clairvoyant valuation. So he said, okay, imagine if I knew all the future dividends that were going to be paid. And once I got to the end of the known dividend path, I took the 10-year growth rate of dividends and did a constant dividend discount model, and I could estimate the valuation. So it's called perfect foresight valuation. So that's the green smooth line. And the blue line is effectively what prices actually did. So prices move around a lot more than fundamentals, even if you knew with absolute certainty what future fundamentals were going to be. So something's driving prices driving prices around more than the underlying cash flows. And so we think that's a combination of sort of psychology, biases, but more on a sociological level, like groups of people, not individuals, and also risk. There are times when, during the Great Depression, people had to be paid a lot of money to bear risk. And so that's what we think is getting captured here. And so what we're looking for is where we see these gaps between price and value. And they're the ones where we seek to adjust the portfolio through time. So how could you do this? So this is a cyclically adjusted P ratio for the S&P 500 back to 1871, and the ratio starts in 1881 because this P ratio uses 10 years of earnings. So it's a cyclically adjusted PE. It tries to remove the effect of the economic cycle. So instead of using the trailing 12-month earnings in the ratio, it uses the average over the last 10 years and it adjusts for inflation. So it gives you more of a through-the-cycle earnings figure. And you can see that the valuations moved around a lot over this period. Really, really wild swings. And so if we look at that, we ask ourselves a question, was there a good time to buy stocks based off this ratio and a good time to avoid stocks? And so what we do is we rank this P ratio from highest to lowest, and we break it into quintiles. And we say, okay, quintile 1 is when it's at its most underpriced or cheapest, and quintile 5 is when it's at its most expensive. And then we look at the average returns that you can generate if you bought in that quintile. So if you purchased equities from quintile 1, on average, you generated about an 11% return above inflation for 10 years. If you bought in quintile 5, you got a little over 2%. So the gap between these two quintiles represents the opportunity from a valuation-driven asset allocation perspective. When stock prices have historically been low relative to fundamentals, average returns have been higher. When stock prices have been high relative to fundamentals, average returns have been lower. This is something that I think is very logical, and it's probably what you would expect. Now, this makes it look like it's easy, but to actually buy stocks here, you are buying in the early 80s, or you're buying in the early 30s. To avoid stocks here, you're not owning US stocks in the late 90s. Very hard to do. And so we think there's a reason why the opportunity is there, and also a reason why other people can't take advantage of it. And it's got a lot to do with psychology and agency risk, which I'll talk about a little bit more. So what that analysis shows is it's effectively absolute valuation. How cheap is the market relative to its own history? We can also look at it on a relative basis. How cheap is one market relative to other equity markets? So this is a pretty stylized view of price and fair value. So you can see here, imagine this is a fair value, and then we have the price moving around. What we find is that at extremes, so the price is really below, there's a really low potential for losses and a high potential for returns. And when price is high, there's a lower potential for returns and a higher potential for losses. The behavior that we see down here is the opposite. Effectively, expectations for the asset class are very low. Generally, flows are low or negative. Holdings in the asset class are declining relative to history. Sentiment surveys suggest that you should probably give up on this asset class. And there's not a huge amount of investments or stocks or securities changing hands at the bottom. On the other hand, up here, where you don't want to own the asset class, well, that's generally where expectations are very positive. Trees growing to the sky. You've got flows that are normally very large relative to history and other asset classes. You've also got holdings in people's portfolios that look much larger than history. Sentiment's very positive, and normally there's a lot of stocks changing hands at the top. So what we find is that at extremes, investors extrapolate, and it creates an opportunity to stand against those positions. And so when we're looking at opportunities, ideally we want to buy here and we want to avoid here. But most other people don't want to buy here and they want to buy here. And so it means you've got to behave differently. I'll give you an example back through time. So I'm going to look at a number of equity markets, and I want to see if valuation would have helped you perform better on a relative basis by picking different equity markets using valuation. So we've got a universe of equity markets, and we're going to divide them into 3 buckets. Most attractive, so that's the cheapest third. Least attractive is the most expensive third, and we're going to rebalance them monthly. Now, for those that want the details, we use 4 valuation measures, which kind of reflect the approach we take, but they're objective measures. So what are the price to sales, price to book, the CAPE using 10 years, and then the CAPE using 5 years, so 4, and we just equally weight those signals. So we're looking at multiple factors. Across 24 countries, we're going to build 3 equally weighted portfolios, and we're going to calculate this monthly from 1975 to 2016, and to see whether or not valuation would have helped in a portfolio context. So if you'd invested $1 in the cheapest third and rebalanced every month for 42 years, you would end up with about $101. If you'd done the same thing with the expensive third, you would have ended up with about $5.20. So this is about a 4% annualized return. This is about an 11.7% annualized return. So there was over 7% difference in return between these 2 buckets. Now, you know, you might be wondering, well, if there's such a big gap, why doesn't everybody take advantage of it? And the reason is that you are effectively going through economic recessions, banking crises, oil embargoes. There's no end of bad news that hits certain stock markets at times. And so, for example, in the most attractive portfolio, in the early 90s, you had to own the Swedish stock market. Now, that was a huge banking crisis, one of the biggest banking crises that we've seen around the world. You had to buy it when everyone else was giving up on it. At the same time, down here in the 90s, you needed to effectively own 0 US stocks. The best performing asset class on the planet, you own none of it. So it's really hard to do. So there's a combination of sort of group dynamics and agency risks that prevent people from taking those contrarian positions. But we think there's a big opportunity there because it's hard to take advantage of. And if it was easy, the returns wouldn't be available. And so to be able to take advantage of these things, you need to have a process. You need to have a framework. So Buffett outlined this very well. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. Now, again, that sounds very easy, but in reality, it's quite challenging. And so when we're looking at asset allocation, we look at 4 different factors. We have a framework, an intellectual framework that allows us to make decisions that tries to prevent emotions from corroding our process and conviction. And so firstly, we have absolute valuation. Is the asset cheap relative to its history? So that's the longer CAPE ratio calculation, something similar to that. Is the asset cheap compared with similar assets? So that's the relative, looking at the 3 buckets. is there evidence of extreme investor pessimism? Is it very unpopular? And then finally, what's the potential for a permanent loss of capital? Yeah, it ticks all three boxes, but is there a risk embedded in there that the market's seeing that we're not seeing? And we need to understand that. And what is the potential that the future looks very different to history, such that our models are not very useful? So we cover 200 equity markets, 150 bond markets, and 30 currencies using this approach. And our asset allocation and portfolio management team update the models and the indicators every month, so we're able to scan the universe around the world. So if there's an opportunity, we're gonna find it, and we can implement it. The one I'm going to spend a bit of time now on is effectively the contrarian indicators, and I think it's a super interesting topic, and I've got a full presentation on it if people have trouble sleeping tonight. But Chris mentioned a quote before. Be fearful when others are greedy and greedy when others are fearful, by Warren Buffett. So in there, he's effectively saying, at extremes, do the opposite of the crowd, which is a very contrarian statement. And so given contrarian investing is important to us, and we think important to a lot of investors, we wanted to understand a little more about why contrarian investing works. Is there more of a science or an explanation behind it? And so John Maynard Keynes is one of my economic and investment heroes. And so he wrote this in a letter in 1944. The central principle of investment is to go contrary to the general opinion on the grounds that if everyone is agreed of its merits, the investment is inevitably too dear and therefore unattractive. If everyone likes it, it's probably expensive, so you shouldn't buy it. Now that actually goes against what a lot of us have had bashed into our brains for a couple of decades by traditional finance courses. So there are two main schools of thought within markets explaining how asset prices are set and investor behavior. There's the efficient market theory, and then there's what we'll call the behavioral finance theory. So efficient market theory rests on three key sets of assumptions. Investors are assumed to be rational and they value securities correctly. So an efficient market means that the prices reflect all available information and it's not possible to systematically outperform the market. If people aren't rational, those that are irrational, their errors are random, they cancel out. So the trains still run on time. Even if you're unlucky enough to have the errors not cancel out, we have these arbitrages that have an infinite amount of capital and patience that are going to come in, and they're going to buy the cheap thing and they're going to short the expensive thing and they're going to drive prices back, get the trains back on schedule. So this was really a very persuasive argument, very appealing, and it really dominated finance for a number of decades. But there are a couple of Israeli psychologists who had asked themselves the question, is anyone really rational according to those the traditional finance theory? Because when they looked at themselves, they didn't think they were rational. So they did a series of experiments, and they actually found that people regularly violate the assumptions that are embedded in this rational school. Effectively, the rational school requires people make decisions or choices in a very consistent way based off expected utility theory. And when they're presented with new information, they update their expectations based off that new information correctly, consistent with what Bayes' formula would recommend. Now, I know everybody knows this because we're all rational, so we do this automatically in our head. But they're able to show that actually people aren't rational. And because they were pretty annoying, they actually went on to show that not only aren't people rational, they err in the same direction. So they were able to show that if you can present a group of people the same data, they will make mistakes in the same direction. So generally, people will err in the same direction. But this is probably the most interesting of the three. And then finally, arbitrage. In the real world, which I call the annoying special case for academics, arbitrage actually doesn't work that well. Generally, arbitrage happens with other people's money. It can be borrowed. You need a short security, so you need to be able to get your hands on the short securities. You actually need to be able to hold the position and potentially double down on it, which is really difficult to do. And so what happens in the real world is that arbitrage is very risky, and arbitrageurs are risk averse, and they don't push prices back to fair value all the time. So in the LTCM crisis in 1998, actually, instead of arbitrageurs swooping in and buying the illiquid securities and shorting the liquid ones, they were actually putting momentum trades on. They were pushing things further away. And so what we find is in reality, arbitrage just isn't anywhere near as effective. So there's flaws in all three of the efficient market theory assumptions, challenges to them. But at the same time, we know markets do a pretty good job over the long term. Prices tend to do a pretty good job of aggregating information. And market prices are very hard to beat. So we know historically investors have struggled to beat the market. At the same time, what behavioral finance theory suggests is that it's a mug's game. Actually, prices don't have to be right. And that's important. Behavioral finance doesn't mean you can make lots of money. It means that the prices may never be right. Now, if you're an investor, it's no good buying something that you think is cheap if you don't think the prices will ever reflect fair value. So you need efficiency. So you need these guys to be right in the long term and these guys to be right in the short term. You need short-term irrationality and long-term rationality. Well, how does that fit together? Well, very difficultly from a logical perspective. And so why is it that individually people behave this way, but collectively prices look like they get set by the efficient market? And so when I can't work things out, which is quite often, I go and read some Berkshire Hathaway letters. Observing correctly that the market was frequently efficient, academics, they went on to conclude incorrectly that it was always efficient. The difference between these two propositions is night and day. So the market is frequently efficient, but not always efficient, which is consistent with both schools being partially right and partially wrong. But why is it? What makes it frequently inefficient? Infrequently inefficient, but frequently efficient. What is it? What's the thing that changes the market structure? And this is where I think we see some pretty interesting results from a field called complex adaptive systems. I'm not going to go into that in a lot of detail, which you'll be happy to know. But who's heard of the wisdom of the crowd? Yep, okay. So Jack Traynor did this originally with some of his students, but then Mike Mobison did it more recently with some MBAs from Columbia. Effectively, he got a group of MBAs, 73, passed around a jar of jelly beans and had each of them guess how many jelly beans were in the jar. And there was a really wide range of guesses, 250 to 4,100, really wide range. He gave an incentive. He said, whoever's closest to the pin gets $20. Whoever's furthest away gets ridiculed on stage. So we think our friend here who put 4,100 was the person that was going to get ridiculed. He says he never did that, but he wanted to create the incentive to be right. So the actual number was 1,116. The average guess was 1,151. So 73 people, they got within 3% of the actual number, which is pretty fascinating. That a group of people, from what I understand, they weren't studying jelly bean counting at Columbia. And you can see by the wide range of outcomes that actually there are a lot of people who didn't have an idea about how many jelly beans were in the jar. But yet as a group, they were quite accurate. So this is what's called the wisdom of the crowd, and it's actually an emergent phenomenon in a complex adaptive system. The wisdom actually emerges from the agents engaging in an independent way. Now I'm going to do an experiment, so maybe we can switch over to Mentimeter. So take out your phones. That means people have to wake up. And go into the website. Maybe, do you want to shrink that down? Just, yeah. I need to see the website. Yeah, sorry. Okay. There we go. See that at the top there? Yeah, shrink that down so I can see that. The www.menti. So go to www.menti.com. And use the code that can only be seen at the top of the screen by the people at the back who are going to yell it out to me. Sorry about this. Just need to minimize it. Sorry about this. Every presentation I've given on this tour, something has gone wrong. This is the first time this one's gone wrong. Okay. How hard is it? Yeah, yell it out. What do you... Well, this is pretty annoying. You just go back. Now this is really out of control. Okay, what was going to happen, right, was you were going to choose a number between 0 and 100 in months that was, what is it, 543197. 543197. Is it, what's that? Yeah, that's right. Exactly.
You're asking a question about African elephant?
That's right.
That's the one, yeah.
Okay, can people bring it up? All right. So let's switch back to Menti. Sorry about that. Yep. Okay. Let's see. We got 31. Okay, let's keep going. All right. Apologies for that. Okay, 57. Wow, a lot of votes coming in. 59, 62, 64. Okay. All right. That's good enough. We'll show results, please. You just have to click. Yep. You just got to go back to the... All right. Okay, I'm going to give up on this. Sorry about that. Fucking hell. We got a phone ringing as well. I'm going for the trifecta. Once they work out how to bring it up, do you want to just switch back to the presentation so I can keep going? Well, wait until, we're going to have the results at some stage. Okay, well the answer is 22 months, and my guess is that the crowd guess would be within 1 month of the number. And you would have all been amazed because it would have worked really smoothly. And we would have all just patted ourselves on the back for being an incredibly intelligent, gifted guessing group. So effectively, what happens is with the wisdom of crowds, we actually violated it a bit because we weren't meant to talk to each other during it. But what you want for the wisdom of crowds to work is you want diversity. You want cognitive diversity where agents are heterogeneous, they're different. Right? So think about it in the markets. Short-term investors, long-term investors, momentum investors, fundamental investors, value investors, growth investors, retail, doing different things. It requires cognitive diversity. That means thinking differently about problems. Having a different perspective. This is the problem I think it is. Different interpretation. This is how I solve that type of problem. Different heuristics. These are the rules I use. And then finally, different predictive models. You have different cause-effect assumptions. So when you have diversity, the crowd works pretty well. So what happened with the jelly bean example and what would have happened with the elephant example is that a lot of people don't know, but the errors are random and they tend to cancel out. So similar to the second assumption that efficient market theory says is that actually when the group is diverse, errors cancel out. You also need to aggregate the information. So here we would have taken an average of people's guesses, but think about the stock market. That's where information's aggregated. And then you need incentives, rewards for being right or wrong. So you need to, for example, in the markets, if you're right, you make money. If you're wrong, you lose money. So the wisdom of crowds requirement is what we think allows prices to be set effectively. And when any of these assumptions don't hold, then prices don't work effectively. What happens is that the wisdom of crowds doesn't work. And so we think the most common way it doesn't work is the diversity requirement. What happens is people copy each other. And so in reality, markets are not always populated by heterogeneous agents. They're effectively populated by people that like to copy each other. And when people copy each other, prices aren't set effectively. And so there's something called the diversity prediction theorem, which says that the individual error, or the error of the group, is offset by the differences in the guesses of the group. So even though we laugh at our friend that was off by 4,100, You want errors, you want people to have quite different guesses generally. And so the bigger the difference in the guesses, the lower the collective error. And so market prices are effectively set by a wisdom of the crowd type mechanism. And when things aren't working well, it's normally because people are behaving in a similar way. Now, how it manifests itself in markets is effectively extrapolation and bubbles. What I mean by that is when people see other people doing something effective, doing something well, they copy them. And that is imitation. It's a really important part of our cultural evolution, the transmission of huge amounts of information over generations so that people don't have to learn things the hard way. Imitation is a really effective heuristic, but in certain environments it's not, and markets are one of those. And so what we find is you get these periods where people will effectively extrapolate the past and people will jump on the bandwagon, and then every now and then you'll get a big bubble forming where there's a mass breakdown of diversity and literally the vast majority of people are copying each other and doing the same thing. Now, when that happens, markets become fragile, the wisdom of the crowds is not working, prices don't reflect available information, and there's an investment opportunity or a really big risk to be avoided. And that's what we're looking for within our process. Now, what we think is that well-functioning markets have diverse participants. A breakdown of diversity actually leads to fewer investor types, people doing similar things, and then, say, value investors or contrarian investors exiting the market. Now, you need the value investors because we're the agents of negative feedback. And I don't mean that we like to say negative things to people, but when we think about a thermostat, where you've got the temperature drops, the thermostat kicks in, and the temperature heats up, right? And it gets too hot, maybe the air conditioner comes on or the heat turns off. And so it's effectively a negative feedback. It keeps the temperature stable. Value investors effectively perform that function in the markets. And when they're gone, what happens is that the prices can be misset. And so for value investors or contrarians like ourselves, it means actually that you're going to be quite lonely. Because generally, if value investors have exited the market, they're going to be sitting off on their own while the great majority participates in this huge asset price rally. On the other hand, we're also going to be lonely because if we're buying something that's really out of favour, the majority has generally shunned it. So it's going to be us and a few other value investors trying to read each other's investor newsletters to, give ourselves confidence that we're right. And so it turns out that it's a pretty lonely experience being a contrarian. So to help you behave consistently, checklists can be quite important. They're quite useful aids, even for really intelligent people like surgeons. Checklists are shown to be effective. So for us, we like to see if most investors are underweight, and ideally we can start to see some contrarians or people that share somewhat similar philosophy to us investing. Earnings or the cash flow expectations are generally pretty low. We see sentiment is generally negative. Trading volume is low. Again, there's not a lot of stocks changed hands in March of 2009. Is volatility high? Generally, volatility is high. It's risky. People don't want to invest in it. And valuation ratios are low. And so things like P ratio. So if we can tick all these boxes, generally we'd say, okay, it's likely that there's an investment opportunity there, but it's not a guarantee. It has to be underpriced. We want to be able to buy something. So the checklist helps us, but it doesn't guarantee success. So we find unpopular investments are really useful, really good places to look for underpriced investments, but they're not a guarantee. Warren Buffett had a great quote. He said, a contrarian approach is just as foolish as a follow the crowd approach. What's required is thinking, not polling. Well, I ignored that and I did a poll anyway, but it didn't work. So central to our view is that market prices work pretty well most of the time, but not all the time because of the wisdom of crowds breaking down in a complex adaptive system structure. So with that said, how are we positioning our portfolios now? I'm going to look at the aggregate. So are we aggressively or defensively positioned? I want to spend a little bit of time on our thesis behind that. So this shows you our 10-year expected returns or valuation implied returns for US assets. So this green line is what we think would be fair. This is where US equities, US bonds and cash are now. This is where they were in June 2018. So what's happened is that the returns have gone up because the prices have fallen. And so things are a little more attractive, but relative to what we think fair looks like, they're not even close. So we think the US stock market is still quite overpriced. And this cycle, it's been primarily the US economy and the US corporate sector that's been driving the global economic cycle. And so I'm going to focus in a little bit on what concerns we have within the US. So this is the unemployment rate for the US. And so anyone that can read a graph can see that unemployment is very low relative to history. Now, unemployment tends to be a lagging indicator, so it's not very good at telling you what the current situation is. And generally, when things have been extremely low like this, there's a recession as interest rates tend to get tightened, as costs tend to rise for corporations. And so despite it looking strong, we think this is actually a negative leading indicator for the economy in the US over the next 3 to 5 years. Now, at the same time, earnings in the US are expected to continue on in a straight line. So this shows you the earnings per share for the S&P 500. This shows you the 99 peak. That's what consensus thought was going to happen with earnings. That's what actually happened. 2007, again, very bullish, didn't turn up. And then this is where we are now. So consensus is very positive still on earnings. And we think that there's a lot of reasons to be concerned over the medium term. So the labour share is very low. There's been one-way traffic for corporates in the US for a long time. So globalisation, breaking of the unions, taxes continually falling, interest rates being very low. And so what it's meant is that US companies have done very, very well. Now, we think that there's still great companies in the US, but we don't think it's reasonable to have these kind of expectations. With the tax impact rolling off, we think there's potential challenges for US corporates over the next 3 to 5 years. And so whilst things look good now, as investors, we have to be forward-looking. Now, there's another issue in the US which kind of really concerns us, and that's the credit markets at the moment. So this is the sub-investment grade credit market, so bank loans and high yield spreads on this chart. And you can see spreads are low relative to history. Not the lowest that we saw before the global financial crisis, but they're low. Generally, what drives defaults is a decline in aggregate revenue. So as the cycle matures, corporations increase their fixed cost because they've got more volume, and they tend to increase their leverage relative to their revenue. So that their cost structure is quite different late cycle versus early cycle. What that means is it doesn't take a very big change in revenue to drive margins down very quickly. And that tends to cause the severity of the crisis. It's operating leverage and financial leverage that hit at the same time. And so what happens is that when defaults are very low on a 3 to 5 year basis, you're better off expecting them to move to average or above average rather than stay low. And we're late cycle, so we think this is a worrying sign. Even more worrying is that nearly over 80% now of loans that are issued in the US are covenant light. So what that means is when you're lending money to a company, you have a contract, an agreement. And in there it has specific terms about where you are in the capital structure, what they can do with their dividends, how much extra debt they can take on. Well, now we're seeing a huge amount of bank loans which have very little constraints on the company. So if you're investing in debt, it's important that you remember that it's you versus the company. You're not a partner in the business, you've got a contract because things end up in court. So they're not on your side. The CFOs don't want you to do well. They want to pay you the least amount of money possible and have the greatest amount of flexibility to adjust their balance sheet. And so this is kind of worrying. So about 40% of this issuance relates to private equity buyout debt. So we're seeing deals get done on relatively high EV multiples and debt multiples. And so this is concerning. Also, within the investment grade credit market, there's about 49% of the market is now triple B. About 5.3 trillion, I think, of debt is triple B. That's one grade to sub-investment grade before it gets dropped down to junk. So what that means is that if there is an economic recession or a slowdown, there's a lot of corporations that will get dropped out of the investment grade index into the sub-investment grade index. Now, the commentators I read out there are all doing the classic thing, but the economy is really strong right now. We think that's a low probability. Well, generally the economy is strong before recessions start because the recessions are caused by central banks tightening and the economy itself being strong is what causes it. Economic recessions are endogenous generally, they come from within the system. So the risk is that that triple B debt gets downgraded and you have a lot of forced sellers. There's a large number of institutional investors who can't own sub-investment grade debt. So when it gets downgraded, they have to sell it. Now, liquidity in the bond markets is very low at the moment. So forced selling in bond markets now would be quite risky. And so bonds are where, so credit or corporate bonds and loans is where capital markets meet the real economy. Companies have to finance themselves. And the credit door doesn't sort of slowly close, it slams shut. It goes from being open to completely closed. And so generally, part of the causes of a recession is actually the credit market closing up. And so we think there's the ingredients there for bad things to happen with corporate balance sheets, and it's a classic late cycle risk that we're seeing. At the same time, investors have generally been pretty bullish stocks this cycle. This shows you, it's a survey of global fund managers, and it says what percentage of them are saying they're overweight stocks. And really, we've seen a very minor period in the last 10 years where investors said they were underweight. So most of the time, investors have been very bullish, and that builds up. So we would say that investors are cumulatively holding a lot more equities than they have previously in the cycle. So it means what we think is sentiment's quite strong towards equities. And investors as well are taking on a lot of margin debt. So this is the margin debt for New York Stock Exchange, which effectively shows how much debt people are using to buy stocks. And so this dot here was 99, this dot here was 2007, and this is where we are today. So again, I'm not saying this is a perfect predictor of market collapses, but when I'm trying to answer the question, are investors aggressively positioned or defensively positioned? Are investors cautious or are they risk-seeking? To me, I still end up on the side of the thing, this is not a cautious investment behavior. So when we balance all these things up, prices are high relative to history and fundamentals, returns are low, so spreads are low, bond yields are low, cash rates are low, stock prices are high, risks are elevated. When valuations are high, the probability of losses is larger. At the same time, fundamentals are strong, but we would argue unsustainably strong. We're seeing classic late cycle fundamental developments, which leaves us more concerned. Generally, people extrapolate, but most of the time over longer horizons, assuming things revert to the mean is actually a more sensible approach. Credit's cheap and it's plentiful. And one of the most important factors to look at is that there's large volumes of new issuance at low quality. And then when we look at what investors are doing, we're seeing return-seeking behavior and low risk aversion. So when we go through that checklist, we would say, well, on balance, we don't think you should be aggressively positioned. We think you should be defensively positioned. Now, if we look back to this time last year, we would say you should be taking more risk than you were at the end of 2017 because asset prices are more attractive. The reward for risk is improved, but only modestly. So we would like to see the opposite of most of these things for us to be really aggressively positioned. And so from a bottom-up perspective, what that means is that we're going to be investing in the more underpriced parts of the market, but also investing in high-quality investments, so avoiding sub-investment grade debt, avoiding bank loans, holding higher quality US Treasuries. So Clint's going to talk a bit more about the portfolio positioning. So with that, I'll just quickly recap. So valuation-driven asset allocation is really driven by our 4 pillars of our approach, and ultimately we're trying to buy things for less than they're worth and applying it to asset classes as well as underlying securities. And markets are set generally by the wisdom of crowds, and a breakdown of diversity is when markets don't work as effectively, and that's where there's potential opportunities. And finally, right now, the reward for risk is not as attractive, and so we're still on the defensive side of the equation. But we've got a lot of cash, and we've got short-term US securities, and so we're ready to buy when the market shifts and we start to see investors being excessively risk-averse, when we start to see people giving up on certain asset classes. That's when we like to get aggressive. So with that, I'm going to thank you for your time and apologise for the Mentimeter mess-up. Thank you.
Thanks, Daniel. Before we go to questions, I think there was a Mentimeter recovery.
Oh, we got a recovery. Okay.
Yeah, so you can see, let's see if it.
Look at that. That's great. 21.3.
So we do have specialists in gestation mammals.
Yeah. So we have a very wide range of guesses, but as expected, the average is very close to the actual number 22. And so I'm guessing that there aren't experts in guessing large mammal gestation periods. So what happened was that a few of you probably were very close to the real number, and then a lot of other people had a range of guesses, but those that were over were largely offset by those that were under. So they cancelled out, and the only thing that was left was the people that really knew the answer. And so the noise cancels out. And so we can do this with multiple choice questions. There's different ways of doing the calculation. Our view is this is what effectively leads prices to be set effectively in the market. And then if, for example, we had some tables over there where we planted people to say the wrong number, we could have actually shifted it. So we could have led to a breakdown of diversity by planting people at each of your tables and having someone go, no, I know it's 30. Right? And so imagine that's a breakdown of diversity. That's like people not making their own mind up. And sometimes the smart money or the person that's got the tip is wrong. And that's when diversity breaks down, people copy each other. But thanks very much for your time.
Thanks, Dean.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.